Is it really possible to grow $5,000 into $100,000? And if so, can the growth of $5,000 into $100,000 be accomplished relatively quickly? Stick around, because in this video, we are going to demonstrate that not only is it possible to grow $5,000 into $100,000 relatively quickly, but it can be accomplished in a fairly low-risk manner. The content provided in this video is for informational and educational purposes only and should not be considered as trading or investment advice. Please review the full disclaimer in the description section below this video. To receive all of the great free content we have to offer here at Finance Fitness, be sure to subscribe. Also be sure to stick around until the end of this video, as we have a free gift to help kick-start your path to wealth and abundance. By now, you are likely asking yourself the following questions. Can this feat of growing $5,000 into $100,000 be accomplished by anyone, or would I need to be a financial wizard? What is the method to accomplish this kind of growth, and how long could it realistically take? In this video, we are going to answer those questions and more. Let's start with what this strategy does not involve. We are not speaking about any type of sketchy get-rich-quick scheme. We are not talking about investing in a super high-risk cryptocurrency altcoin, and we are not talking about gambling. While it may not be particularly sexy, the way to safely grow a small amount of money into a larger amount of money is through the truly amazing power of compounding. Compounding is the great equalizer, in that it truly can make almost anyone that has enough conviction, patience, and mental discipline wealthy. In this video, we are going to discuss two potential ETF investment vehicles that, if used safely and with very strict risk mitigation rules, can significantly speed up the path of turning $5,000 into $100,000. Again, it must be stressed that the key to this strategy is combining the power of compounding with the strict adherence to risk mitigation. The two different ETF investment products being discussed in this video can carry significant volatility, and if proper risk management is not employed, losses of 80% to 90% of your capital can certainly occur. The first ETF investment vehicle we are going to explore is the TQQQ. The TQQ is an exchange-traded fund that aims to provide investors with 3 times the daily return of the Nasdaq 100 index. TQQ achieves its triple exposure to the Nasdaq 100 index through the use of financial derivatives and other investment strategies. As a leveraged ETF, it is not designed as a long-term investment, as its returns can magnify both gains and losses compared to the underlying index over time. If held through a bear market or significant and lengthy downtrend in the Nasdaq, losses of 80% to 90% can be suffered. However, in this video, we are going to explore a relatively simple and time-tested strategy for helping to capture most of the upside in any long extended bull market, while at the same time avoiding the catastrophic losses that can occur by using leverage in a bear market. The 200-day simple moving average. The 200-day simple moving average is a widely watched technical indicator used by investors to gauge the long-term trend of a market or security. It calculates the average closing price of a security over the past 200 trading days, smoothing out short-term fluctuations and providing a clearer picture of the overall direction. One common strategy is to use the 200-day SMA as a timing mechanism for entering into the S&P 500 or the Nasdaq 100. When the index or ETF price is trading above its 200-day SMA, it's considered a bullish signal, indicating that the long-term trend is positive. In contrast, when the price falls below the 200-day SMA, it suggests a bearish trend, signaling a potential downtrend in the market. Several famous investors, including Paul Tudor Jones and David Dreman, are known for incorporating the 200-day MA into their investment strategies. Jones, a legendary hedge fund manager, has emphasized the importance of the 200-day SMA in identifying major market trends and timing entry and exit points. So how can the 200-day SMA be used in combination with the TQQQ ETF? Again, risk management and capital preservation is the key if a highly leveraged product such as the TQQQ is being used. The most basic strategy would involve only being long the TQQQ when the Nasdaq 100 is above its 200-day simple moving average. Once the Nasdaq crosses below its 200-day simple moving average, the position in TQQQ would immediately be closed and you would move to cash completely. This is effectively a trend-following strategy in which one is hoping to catch the beginning of a long upward trend and riding it until the trend ends and the market turns over and the downtrend begins. By exiting the long position as soon as the Nasdaq crosses below its 200-day moving average, one can potentially avoid what may be a long and painful downtrend in the market. The Nasdaq 100 has been known to drop 40% or more in value during a bear market. Therefore, if you held a position in the triple-leveraged TQQ through an entire 40% correction, it would wipe out your capital, which would be catastrophic. Again, the number one rule in investing or trading is capital preservation. Timing market tops and market bottoms is extremely difficult, if not impossible. While using the 200-day simple moving average will never get you in at the bottom or out at the top, it can help with capturing the meat or bulk of a long uptrend, while avoiding most of a long bear market and preserving capital. So, getting back to one of our original questions, how long would it take to grow $5,000 into $100,000? Our backtesting results have shown by employing the 200-day simple moving average as a signal to get long or exit, one could have grown a $5,000 account into just over $134,000 between 2013 and 2024, or just over 11 years. 11 years may sound like a long time at first. However, if you actually consider the result of effectively doubling an investment account nearly 5 times over in that period, it really is quite staggering. We should stress that past performance backtests are certainly no guarantee of future results. One should never invest more than a small portion of their total capital in a leveraged product such as the TQQQ. While the 200 SMA strategy discussed in this video can certainly help avoiding losses during a long bear market, flash crashes, while extremely rare, can occur, which can result in significant loss of capital. What is the second investment product that can potentially grow $5,000 into $100,000 in a relatively short period of time? The Bitcoin ETF. Recently in the US and Canada, there have been a number of ETF products released which track the price of the cryptocurrency Bitcoin. The introduction of the ETF makes it very convenient for individuals to have some exposure to Bitcoin without having to actually buy the digital asset itself on an exchange and worry about safe storage. All of the prior comments in this video about risk mitigation and capital preservation apply to the same extent, if not more, to the Bitcoin ETF. Bitcoin is an extremely volatile asset which can easily increase by 600% or more in price during a bull market and decline by 80% or more during a bear market. Those riding a Bitcoin bear market all the way down can suffer devastating losses if they got in near the top, or even if they invested partway through the bull market. Again, history is never a guarantee of future results, and anything can happen. However, studying price patterns for Bitcoin since 2010 can reveal some very interesting repeating cycles. Many professionals have noted that Bitcoin appears to follow a 4-year cycle in which there is a 12-month to 18-month bull market or summer, followed by a 2.5 to 3-year bear market or winter. Keeping track to some degree as to where Bitcoin may be within its 4-year cycle, and also using an entry signal such as a simple moving average, can help one take advantage of the significant upside during a bull market, and at the same time attempt to avoid much of the downside during the inevitable bear market. We have observed that using a 200-day simple moving average may be too slow for an asset such as Bitcoin, given its extreme volatility and tendency to both increase and decrease in value significantly over short periods of time. A 200-day simple moving average would typically get you into the trade well after the bull run is underway, and get you out of the trade well after the price has started collapsing. A faster simple moving average, such as the 120-day, is much better suited for an extremely volatile asset such as Bitcoin. Based on a backtest of the Bitcoin asset itself over the period of 2017 to 2021, had one used a 120-day simple moving average as a signal to enter and exit, an initial $5,000 investment could have grown to a staggering $498,000. Being able to take advantage of a good portion of the Bitcoin bull cycle and at the same time avoiding significant losses during an inevitable collapsing bear cycle is the key. However, it is important to recognize that the 2017 and 2018 bull market provided gains of 1,800%, and gains of that magnitude in a single bull run may never be seen again. If you would like to learn more about trading Bitcoin, be sure to check the link in the description below for the 100% free crypto trading masterclass. To stay on top of all our valuable free wealth building content, please be sure to like and subscribe. We will see you on the next video.